Hey everyone, this is Ryan with Stock Investing and Trading 101. Today is Monday. We got a new start to a new week. Definitely an interesting week for sure coming up. We have in-person trade talks coming up this week, and then a possible rate cut sometime this month. So those are two really big things to look out for. Today I opened a couple of covered calls. I got a $26 credit on AT&T, and I got a $5 credit, and I sold two calls, so $10 credit on forward covered calls. But today, the topic of the video is going to be the dividend capture strategy. I'm sure a lot of you have heard about this, and people have different feelings about the strategy, but for anyone who doesn't exactly know what the dividend capture strategy is, I will be explaining that today and telling you exactly how or if it can work. So, what the dividend capture strategy is essentially it's a strategy. It's exactly how it sounds. You're going to capture a dividend, and what you're doing is you're buying a stock one day before its ex-dividend date. That way, the next day when it goes ex-dividend date, you will receive the dividend at some point. So first, before we get into that, I'm going to break down the dividend timeline. So how this works, and I have a whole nother video of going into deep detail of this, but essentially this starts by the company declaring that they will have a dividend, and the ex-dividend date will be a certain day. And the ex-dividend date is the exact date that you need to own the stock by in order to receive the dividend. If you buy it on the ex-dividend date, it's too late. You need to have it at open before. Pretty much you have to have it the day before. So then after the ex-dividend date comes and you own the stock, there will be a date of record, which is usually 2 days after the ex-dividend date. This is essentially just solidifying the fact that you are the shareholder who is going to receive the dividend. And then there's a pay date, which is the date that you will actually receive the cash. So you need to know this timeline in order to really understand the dividend capture strategy. So one more time, this strategy would be done by purchasing a share uh, one day before its ex-dividend date, as you see here. So an example that I'm going to show you guys before I get into some more detail about the strategy is with AT&T. AT&T actually has an ex-dividend date this week on Wednesday. I believe it's the 10th that they have an ex-dividend date, and they pay, I think, 51 cents or maybe 52 cents per share. So essentially, if you were to buy this stock tomorrow or today and hold it until Wednesday, and you could sell it right at open, you could sell it at close, and you could hold it if you want. Essentially, what that would do would be if you were to hold it into the market open on Wednesday, you would be the holder of on the ex-dividend date. It would go down on the record date that you're getting the dividend, and whenever this is paid out, probably in a couple of weeks, you would receive the cash. So this sounds really good, right? This is like perfect. Like, look, I can invest in a stock, I can get a dividend, and I don't even have to hold it very long, and I can just get free cash pretty much. And that's how most investors think of this strategy. When I first got into the market, this was a strategy that I thought, this is a really good strategy. I definitely would like to do this. And the issue with this strategy is on an ex-dividend date, the amount of the dividend comes out of the stock price. So once again, with our AT&T example, let's just say right now the price is 37.80 for simple math, and we're going to say the dividend is 50 cents even. On Wednesday, which is the ex-dividend date, at market open, AT&T would open 50 cents lower than it was the night before. So that's kind of how it works, meaning that your shares would lose value equal to the amount of the dividend. One way to think about it is that the dividend is coming right out of the stock price. So once again, if we're at 37.80 and it pays a $1 dividend, for example, the $1 would come out of the stock price. So it would start at 36.80, and from there it can move up or down. And it doesn't necessarily, sometimes it will open and go even lower than the amount of the dividend. So just because the dividend is 50 cents or whatever it is, doesn't mean that the stock is only going to go down 50 cents that day. There's a good chance that it can go down even more that day. So what this means for the dividend capture strategy is that while you will capture the dividend and you will for sure get that income, the stock price will be down and it will pretty much equal itself out. because if you're getting a 50-cent dividend and the stock loses 50 cents of value, you're pretty much at square one. And that's not mentioning the fact that you have to pay taxes on dividends. So at that point, you would actually be losing money. This isn't a strategy that I'm very it's not a strategy that I like very much because I've tried it personally and it just didn't really work well for me. I was doing it, and eventually I would just have to hold the company until I could sell it back, and then that's how I would make some money. But it just wasn't worth it, and especially if you're not doing it on good companies. So that's one thing that I would definitely note is that when I was first doing this, I would look up all the ex-dividend dates, which you can do on the NASDAQ website, and I would just find a stock with the biggest dividend that I could capture, and I would buy it, and the next day the stock price would usually tank. I would get the big dividend eventually, but due to the loss in stock value, it just wasn't worth it for me. So that's essentially what the dividend capture strategy is and the basics behind it. Many people aren't really a fan of the dividend capture strategy for the reasons that I've mentioned about how it's taxable and the stock price will go down that amount of value. But for some people, they can make it work. And while we're on the topic of ex-dividend dates, this is definitely a good time to possibly be buying a stock. So if you weren't looking to do the dividend capture strategy, but you still wanted to invest in a dividend-paying company, for example, if you wanted to invest in AT&T, but you didn't want to pay, 37.84 per share, almost $38 per share, you could wait until Wednesday, which is the ex-dividend date, and most likely AT&T will open around well, let's just say 37.30 because I have no idea where this stock will be tomorrow, so I can't exactly predict where it'll be at. But for example, if the ex-dividend date was tomorrow, this stock would open 50 cents lower than it is right now, or the amount of the dividend. So that's one thing to note. It can be a good buying opportunity to actually buy on the ex-dividend date because a lot of times, like I mentioned, the stock will actually go down more than the amount of the dividend. So this stock could easily go to $37 on Wednesday because the dividend has been taken out of the price, and many people were holding it just for the dividend. Now they want to sell it, and the share price will fall. So it can be a good buying opportunity on the flip side of the dividend capture strategy. So that's really the whole strategy. It works for some people. It doesn't work for most people, I would say. And I'm not a huge fan of it, but I do want to bring it up for other people to, at least realize what it is and decide for themselves if it's a good strategy for them or not, because everyone has different investing techniques and strategies. So thanks for watching my video, guys. If you have any questions or anything was unclear, definitely feel free to ask in a comment below, like the video, subscribe to the channel, and we will see you guys soon.